Okay, welcome everyone. We'll start our lesson 3. Today lesson will go through LO3. As you know, my name is Anjum Sathar. Please, if you have any question, you can drop me an email, anjum@ukversity.co.uk, and I'll try my best to get back to you as soon as possible. We'll start. So today lesson is about LO3, which is understand the management long-term finance. So finance is mean borrowing money. We have different sources of finance. It can be debt financing and equity financing. So we can divide finance into two, debt financing and equity financing. That is normally, according to the various authors, that is cheaper than equity. So when we say debt financing is a cheaper than equity financing. So lesson 3 is about understanding the why debt is cheaper than equity, because the debt, when you borrow money and any interest you pay on the debt is expense for the business. We minus from our profit and loss account. So it means we have to pay the less tax, and we can save on the tax. So when we have equity is the dividend we paid after the tax. So it means we don't have a facility to save the tax, by law. So that's the key difference. But we need to be make sure there is a balance between debt and equity financing. Make recommendation on the management of the debt and equity, and the dividend evaluation model determine the share price and the cost of capital, and evaluate the useful of capital asset pricing model. That will be the key in our discussion. Make recommendation on the management of the debt financing and equity. So it's quite good, if you're doing the debt and equity financing in debt and equity finance, and next to that, if you write the word Kaplan, so we can find different sources of finance. What is the difference between debt and equity? So it's quite good. Couple of you hope you can see it here. So please, good to look around and you can enhance your understanding about debt and equity. Debt is main alternative to equity finance and is a sources of finance that is usually viewed as a low risk, because in the company point of view, we can look around advantage, bank loan, overdraft, bonds, loans. Yes, overdraft is the short term, but bond is the long term. Deep discount bond, hyper convertible loans, notes. So these are each advantages, and this leasing is finance lease, operating lease. So these are all the source of finance in that finance. When we say equity, equity means shares, which we can issue to the public. So we can use equity financing, yes, see, and relating to raising equity, which we can difference between equity and debt, and how we can unquoted quoted shares in the stock exchange and amounted, and how this impacts. So that's quite good to. So if you look on the Kaplan in, so please, it's quite good to be. If you look the capital structure in the organization, like if the structure is a debt financing or equity financing which we're using, and we have a lot of theories which we can look around. That's in terms of the tax, in terms of the weighted average cost of capital. You will see here example, Miller and Maldiani MMF model is very popular. That is the cheaper than equity weighted average cost of capital, where we can look around dividend growth model, which lot of examples, please, for your assignment, statics theory, and other theories, for of the debt and equity, why is cheaper, and what are the difference between debt and equity. So that's quite good to explore, please. So we discuss about short-term sources of finance and the long-term. Long-term normally it can be lease, it can be equity, it can be hybrid, leasing, venture capital. Equity can be short-term, but normally the equity is clustered as a long-term. Short-term source of finance can be overdraft. Okay, these are different sources of each has the pros and cons. So we can look around optimal capital structure. Remember the graph of cost of equity versus the gearing. Static theory, the firm is established position will adjust their current level of gearing to achieve a target level. So we can look around picking order theory, which is the firm order have the preferred hierarchy of the finance decision. So why choose the debt financing? In the long run, debt is cheaper than equity. That give you the tax benefit. A lender isn't going to tell you how run your business. So for business with a sticky revenue stream, that can be very accelerative and more time is actually run your company. We choose we choose the debt because the debt is cheaper than equity. No interest payment, no liabilities, no monthly payments. Only you pay if you have a profit. You can pay the dividend. Operational experience in the case of venture capital and uh, P/E ratios, which we follow up funding. That can be question mark. So which financing option? So we can the best, the capital structure for the business is the capital structure to minimize the business's weighted average cost of capital. Whichever structure you use, the average cost of capital should be lower in the long run. Either you use the debt. So we also look around the gearing. What is meant by gear? Like if you have too much debt, more than 60% your debt and less your equity, is ultimately what will be happening. It's impact, huge on the profitability. So we have and it's increase the risk. If you can't afford it, then of course it can be raise the concern. So that can become, and the company can be goes in the liquidation if you have. But if you can't pay the dividend, because the investors maybe can wait 1 or 2 years, like Amazon, few years they not paid the dividend to the shareholder. They said this is the incubator, and when it's coming in the check and you will earn more as the CEO of the company Amazon. So we can look around the debt, total debt leverage and the total equity. So we have to proportion it, and you have to look around the risk and the return. Okay, so flotation cost, issue debt, high, issue equity low, interest rate, issue equity high, issue debt low, tax rate, issue equity high, issue debt low, earning volatilities, issue equities high, issue debt low, business growth, issue equity high, issue debt low, percentage the debt structure, equity high, debt low, percentage of equity, issue debt high, and issue equity low. So these are the balance we have to look around and we have to design, and that's the debt to equity structure which we can explore and we can measure the risk and reward of, and the weightage of a cost of capital is a crucial. Anybody, any question from? Yes, yes, no, no, no question. Let's move to the issue. The use of the dividend evaluation model to determine the share price and the cost of capital. Okay. Dividend evaluation model stated the value of the share can be estimated at the present value of the future dividend discounted at the share required return. To calculate the shareholder required return, the cost of equity, we work backward. The share price PV of the future dividend discounted at KE. K is the cost of equity. If we know the share price and the future expectations regarding the dividend, then we can reduce the cost of equity. So dividend evaluation model DVM is assume the market value of the value or the share price of the company based on the expected dividend stream expected. So this is based on the number of our estimation and the forecasting which we can look around. PE equal to D naught 1 plus G, cost of equity minus G. G represent growth. So we can say estimated current dividend share price, dividend per shares today, and G the expected annual growth of dividend. We expect 10%, 15%, whatever percentage, and the cost of return required ordinary shares, and the cost of equity. So rearranging the equation give PAE D or 1 plus G P or plus G. So we can look around in a mathematical term. The dividend evaluation cost of equity, D plus dividend plus P naught. P naught is the share price in the naught time at the start, today date. So K is the cost of equity of the decimal, dividend is the constant, and the share price now and the time zero. How to estimate? So two ways estimating the growth rate of the dividend, past dividend, extrapolating the based on the past dividend pattern. A retention model, we have a Gordon growth model, assuming the growth is dividend on the level of earning return in the business. Okay. How to estimate the growth past dividend? So we can G is equal to D naught. What was the dividend now? Dividend in n years ago minus 1, and the dividend n years ago 1 divided by n minus 1, which is n represent the number of years dividend growth. So this can be used to recent dividend pattern is considered typical historical pattern to expect it continues. So estimated how to estimate the growth, earning retention, the key exemption. We can look on a higher the level of retention in the dividend, higher the potential growth rate. So formula G is equal to B times naught. So what is our post-tax accounting rate of return earned and reinvested the fund, and B the bearing is earning retention rate, and or further we can calculate in the part profit after tax opening shareholders fund. So weak dividend valuation model, the current price is subject to the short-term influence such as the market move and political, economic, social, and technological factors carry on changing. So this can be based on, okay. So future dividend, yes, future dividend we use assume no growth constant. However, there is a no guarantee of the dividend future may be sorted the cost of equity calculation and the relevance of earning don't features such as in the DVM. However, the earning should be indicator of the company's long-term ability to pay dividend and therefore estimating the rate of growth of the future dividend. Okay. So then we have a merit criteria 3M. Evaluate the usefulness of capital asset pricing model. CAPM, which is WAC, is the weighted average cost of, here we're looking the pricing. So KE is the cost of equity, R is the risk, RF risk free, B it called beta is the risk factor, RM is the market, and RF is the risk. So K is the cost of return of equity provided by the company, K is return received by the equity investor, RF is the risk-free rate of return. So risk-free is it can be low than the risk, when you're taking risk, you're expecting high probability. So systematic unavoidable risk, the company shares determined by the revenue and the cost. Sensitive RM is the return on the market as a whole, what we expecting, which is prevailing in the market that can be used, in our calculation. Okay, so capital asset pricing model, the market return, risk-free, risk premium between 3 to 9%, and risk-free risk rate is normally taken yield. Yield is mean the return on, how much was the loss, how much is now the bond in the country and where the project is based. So we can beta in the market is a risk factor. So these we can use it. Security comparison, investor use the different security to construct the rate. Portfolio, don't put all eggs in one basket. So portfolio mean many shares. Yes, capital asset pricing model use the modern portfolio theory to the suitable investment for the portfolio, and in the portfolio asset allocation can be determined using the capital asset pricing model, and invested in a list use capital to evaluate again the book value and the market value, and asset is considered to be good deal, if there is a trading lower than the intrinsic value, use of capital asset pricing model, net present value method for all the project capital asset pricing model, discount rate, which is consider higher in the quality of NPV. Therefore, the judge, investment the project of all diverse kind of risk. Risk is the probability of happening we discussed earlier. So better dividend evaluation method, explicitity and consider the company level systematic risk and the stock. And superior weighted average cost of capital is providing discount rate by use the investment appraisal. So investment appraisal, guys, we discussed in lesson NPV, ARR, payback period. So if you're looking back, weighted average cost of capital. So next to that, you can write the word Kaplan, and the Kaplan, you have a chapter of the book, which you can refer back and you can read, please. Is good to be. So when we'll do assignment, weighted average cost of capital formulas, dividend valuation formula, then we have all the explanation, and we can calculate these numerical, systematic, unsystematic risk, which we mentioned, systematic risk, market wider factors such as the state of economy, and non-systematic, the company's industry specific factor that is a non-systematic. Systematic risk affect the company in the same way. So these are all the models and the theories which you can explore more. Yes, weighted average cost of capital you can calculate through using the formula. So you will see the weighted average cost of capital, other models. You've been given some example, risk-free. Yes. So these are all different models you can, and some you can pick an example for your assignment. So that's quite good. Any question from anyone? Okay, no question. Okay, guys. So that's which we can, or if you want that uh, financing, and if you like Kaplan, our financial management Kaplan. So we can find a lot of sources of finance. That's the best way to search sources of finance. So if you write it, so you can find different sources of finance, and that's which we discussed long term. Yes, you will see the picture there in our slides as well. Is being explained, which we discuss cost, term, rate, interest. When you decide, which source is the better, you can decide. And in purchase, what impact will be, debt to equity, lease, and different sources of finance. So each, pros and cons being discussed. So you can calculate. So we have some numerical, which we can code some example in our assignment purposes, but we'll do assignment discussion. So that's all from my end. Thanks for attending to this session, and the next session we'll go through our assignment discussion. Thank you. Have a nice time, and I'll speak to you during our next lesson. Thank you. Bye-bye.